The global energy market is currently navigating a period of unprecedented volatility, characterized by a fundamental shift in traditional oil pricing dynamics. For the first time in 4 years, West Texas Intermediate, WTI, the North American benchmark, is trading at a premium over Brent crude, the global standard. Historically, Brent has maintained a spread of $3 to $5 above WTI due to its status as a seaborne international benchmark. The current inversion, with WTI trading at approximately $112 per barrel against Brent at $109, signals a profound disruption in the relationship between physical supply and paper contracts. This rare occurrence indicates that market participants are prioritizing the immediate acquisition of physical barrels over financial futures settled in cash. While Brent functions primarily as a financial instrument traded in London, WTI requires physical delivery at Cushing, Oklahoma, making it the preferred vehicle for hedging against immediate supply shortages. The premium on WTI suggests a deep-seated concern regarding the duration of the ongoing conflict involving Iran and its impact on North American energy security. Market data reflects a growing belief that Middle Eastern supply will remain offline for an extended period, forcing a reliance on domestic reserves. The next 7 days are projected to be the most critical period for the energy sector in recent history, as 3 major geopolitical and economic questions reach a tipping point: the expiration of the tactical pause on strikes against Iranian infrastructure, the upcoming OPEC production decisions, and the status of Russian oil sanctions waivers will dictate the trajectory of global prices. These variables will determine whether oil stabilizes at current levels, surges toward $140, or retracts to the $85 range. A retrospective analysis of the past 48 hours reveals a complex setup for this high-stakes week. On April 5th, the core OPEC Plus members, including Saudi Arabia and Russia, agreed to a modest production increase of 206,000 barrels per day starting in May. While significant in isolation, this volume represents only 1% of the 20 million barrels per day currently offline due to the closure of the Strait of Hormuz. The Strait of Hormuz accounts for approximately 20% of the global oil trade, encompassing both crude oil and refined products like diesel and gasoline. OPEC's conservative response indicates 2 primary realities: a comfort with prices remaining above $100 and a recognition of limited spare capacity among member nations. While Saudi Arabia and the UAE possess some additional pumping power, most other members are already operating at maximum capacity. Furthermore, export terminals in the Persian Gulf remain inaccessible, regardless of pumping volume, as long as the strait remains closed. Official statements from OPEC regarding the high cost and long duration required to repair damaged energy infrastructure suggest that supply normalization will not be immediate. Damage to LNG facilities in the region is estimated to require 3 to 5 years for full restoration, a factor that exerts long-term upward pressure on energy costs. As of April 6th, the 10-day tactical pause on strikes targeting Iranian energy infrastructure has officially reached its expiration. The absence of an immediate announcement regarding an extension or the resumption of strikes has left the market in a state of high-tension equilibrium. Diplomatic silence from the White House and the Pentagon has caused WTI to hold steady at $112 as traders await a decisive signal. An extension of the pause would likely trigger an immediate $10 drop in prices, as it would indicate that back-channel diplomacy is yielding results. Conversely, a resumption of strikes would likely cause a rapid spike of $20 or more, as it would signal an escalation toward direct targeting of Iranian production assets. Technical analysis identifies $112 as a critical resistance level for WTI. A sustained break above this point opens a blue sky path with little resistance until the $120 mark, followed by a potential run toward $140.
On the downside, a break below $100 would find initial support at $93, with a secondary floor at $85. Leading financial institutions remain divided in the midterm outlook for energy prices. Goldman Sachs forecasts Brent to average $115 through April, assuming a gradual reopening of the Strait of Hormuz starting in late April.
However, their model warns that any extension of the conflict would render these projections overly optimistic. JP Morgan offers a more somber assessment, highlighting a rapid depletion of commercial crude inventories within OECD nations. Estimates suggest a drawdown of 166 million barrels in April alone, moving the system toward its minimum operational level. Below this threshold, the global energy infrastructure loses its ability to absorb supply shocks, making price spikes and forced rationing nearly inevitable. The timeline for the coming days includes the release of the Energy Information Administration's short-term energy outlook on April 7th. This report is expected to provide official government assumptions regarding transit through the strait and inventory levels for the remainder of the year. On April 8th, U.S. Consumer Price Index data for March will reveal the extent to which rising energy costs are feeding into broader inflation. A significantly higher inflation reading would likely eliminate hopes for Federal Reserve rate cuts and raise the specter of 1970s-style stagflation. Stagflation, characterized by high inflation and stagnant economic growth, represents the most challenging environment for both policymakers and investors. The middle of the week, April 9th, is identified as a potential window for major announcements regarding the status of negotiations with Iran. A breakthrough in these talks could result in a one-day price crash of $20 to $30 as the market prices in the restoration of supply. Failure of these negotiations would have the opposite effect, potentially triggering a historic rally in energy commodities. On April 10th, weekly jobless claims will provide an early indication of whether high fuel costs are beginning to impact consumer spending and business operations. Rising gasoline prices historically lead to a contraction in discretionary spending, which can serve as a catalyst for a broader economic slowdown. The final critical hurdle occurs on April 11th with the expiration of the U.S. Treasury's Russian oil sanctions waiver. The decision to renew or allow the expiration of this waiver involves a delicate balance between maintaining global supply and exerting geopolitical pressure on Moscow. Allowing the waiver to expire would remove over 100 million barrels of oil from the market, adding further strain to an already tight supply chain. Current forecasting models suggest three primary scenarios for the evolution of this crisis. The first scenario, a diplomatic breakthrough, carries a 35% probability and would involve an agreement for limited non-military transit through the strait. In this case, oil would likely stabilize between $95 and $100, though permanent infrastructure damage would prevent a return to pre-war lows. The second and most likely scenario, at 45% probability, is a muddle-through stalemate, where the conflict continues at current intensities without a definitive resolution. In this base case, oil remains volatile between $100 and $115, and recession risks continue to climb toward the 50% threshold. The third scenario, an escalation involving direct strikes on Iranian oil terminals, carries a 20% probability, but represents a catastrophic outcome. Such an escalation could push oil prices toward $200 and gasoline toward $6 per gallon, making a global recession virtually certain. For individual consumers, current market trends suggest that gasoline prices at the pump will continue to rise through late April, likely hitting a national average of $4.40. The Federal Reserve finds itself in a policy trap, unable to cut rates due to energy-driven inflation and unable to raise them due to weakening economic growth. As the next 7 days unfold, the data points regarding inflation, employment, and diplomatic status will provide the clarity necessary to determine the economic landscape for the rest of 2026. While the global economy has navigated energy shocks in the past, the current combination of physical supply deficits and geopolitical instability presents a unique challenge to global stability. Preparation and close monitoring of these critical benchmarks remain the only viable strategies for navigating this period of uncertainty.
The inversion of WTI and Brent serves as a definitive signal that the era of theoretical supply security has ended, replaced by a market defined by the immediate necessity of physical energy.